Good day, grade 12 learners. Welcome to today's business studies lesson. My name is Sidiso Tlaka. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sci-Bono Discovery Center. So today we look into the main topic we call the business venture, which is assessed in your term 3 and also assessed in your paper 2 for the final exam. And the subtopic we look into is forms of ownership. Now, lesson outcomes. At the end of this lesson, you should be able to discuss or explain the characteristics of each form of ownership. You should further be able to explain the meaning of limited liability and unlimited liability. You should further be able to discuss or explain or evaluate the impact, which refers to positives or negatives of the different forms of ownership. You should further be able to explain or discuss how the following criteria could now contribute to the success and or the failure of each form of ownership. Those criteria would be taxation. We will look into how taxation can contribute to the success or failure. We'll also look into how management can contribute to the success or failure, together with capital, to say how can capital also contribute to the success or failure of each form of ownership, together with division of profits and legislation or legal requirements. But the first part is to look into the issue of limited liability and unlimited liability. Pre-knowledge, this is what we covered in our previous lesson. So in our previous lesson, we looked into presentation and we started by looking into factors to be considered when now preparing a presentation, together with factors to be considered when now one is actually presenting or while presenting. We also looked into ways in which now the presenter would have to handle feedback in a professional way, together with areas of improvement for the next presentation. As we continue, we also looked into visual aids in our previous lesson, which was on presentation. So we looked into these forms of visual aids to say this is other ways, or these are medias that can be used during a presentation. We looked into video conferencing together with flip charts, together with interactive whiteboards or smart boards, and we also looked into a poster and data projector or a PowerPoint, together with handouts or flyers. So those were basically the critical part of our previous lesson. Now, terminology that is important for today's lesson. Remember, today's lesson is based on forms of ownership. So one critical part is to understand, to say, what do we mean by the term form of ownership? Form of ownership refers to the legal position of the business and the way it is owned. So that is what we mean by the term form of ownership. So we're talking about how companies, how a sole trader, how a partnership, how a closed corporation, how a non-profit company, how a corporation is being owned, and who are the owners. What do we call the owners of a company? What do we call an owner of a sole trader? We are looking into all those. We'll be looking into characteristics together with the impact of each form of ownership. Then we'll also look into continuity, to say now with continuity we are focusing on the idea that it looks into the issue of saying now continue to exist even if a change of ownership takes place. So the focus there is to say, if now it happens that one of the owner passes away, will the business be able to continue to exist? For example, a member or a shareholder dies or retires. With different forms of ownership, some ownerships would continue to operate, while some businesses or forms of ownership would not continue to operate because of the legality or how the business is owned. Then we also look into directors. What do we mean by that? It refers to people elected to the board of a company by the shareholders to represent the shareholders' interests. We also have the term audit, which refers to the process where an organization accounts or are checked to make sure its financial operations are honest. So auditing is a process whereby an organization's account, meaning the money that is in the business accounts, are being checked to make sure that their financial operations are honest or they're being conducted in a legal way. Then we start with the first part, which is the difference between now limited liability together with now unlimited liability, to say what do we mean with those two words, because they are very critical and will also help us understand the differences when we look into some forms of ownership. The meaning of limited liability, this is when now shareholders are only liable for the amount they invested in a company. Remember that a company has now shareholders, and shareholders invest in a company through buying shares. So when we are talking about limited, remember the word limit means to a particular maximum. It ends somewhere. So when we are looking into the meaning of limited liability, this means when shareholders are only liable for the amount they have invested. For example, if the business is bankrupt, the personal positions of the shareholder cannot be used to pay for the debt of the business. So what are we saying there? As a shareholder, let's say you have invested 100,000 to a particular company. Now, you are the shareholder, you have invested in that particular company. What we mean is that if that company becomes bankrupt, it means the business or the company cannot afford to pay their liabilities. They will not be in a position now to sell your assets that you own. They cannot sell your car, they cannot sell your house to pay off the debts of the business because of the issue of limited liability. So what we actually mean is that they are only limited to the 100,000 you have invested in a form of buying shares. They cannot now start thinking about selling the assets or the personal assets of the shareholder to pay off the debt of the business. So that's what we mean with limited liability. The liability is limited to the amount invested to the company in a form of buying shares. So that's what we mean with limited liability. However, when we are looking into the meaning of unlimited liability now, this is the opposite of limited liability, which now I hope you should be having an idea. This is when the owners are personally responsible for all the debts of the business. For example, now, if the business is bankrupt, the personal positions of the sole trader or partners may be sold to pay off the debts of the business. So here we are referring to these two businesses or these two forms of ownership, which is sole trader and partnership, because they are implicated to unlimited liability. So what we mean here is that you can start a sole trader, maybe let's say you invest 10,000. So if it happens that now the sole trader as a business is owing now or is bankrupt, it means now the issue of unlimited liability comes in to say whatever that is being owed by the sole trader or by the partnership as a business should be paid off by the owner. If the owner doesn't have money, then the owner can sell their personal assets, such as a house and a car, to pay off the debts of the sole trader or partnership. So that is unlimited. So that is to say now, whatever that is owed by the business is not limited to the business. It is also limited to what is owned by the owner of the business. So that is to say, there's no limit to say what is owed by the business is limited to the business. It can move to the owner's assets, such as a car. So that's what we mean with now unlimited liability. But remember, with limited liability, we are saying what is owed by the business is only limited to the owner. But unlimited, if the business is failing to pay its own debt, the owners should come in and intervene by making sure that now, if they don't have the money, they can sell their cars to pay off the debts of the business. Hoping that made sense. Now we start by looking into our forms of ownership. We will be looking into the following forms of ownership. We'll look into a sole trader, we'll look into partnership together with close corporation and private company together with personal liability company. And we will also look into your public company together with state-owned company and non-profit companies. And the last one would be cooperatives. So we'll look into the characteristics of each. We'll also start with the meaning, then look into the characteristics, then look into the impact, the positives and negatives of having such a form of ownership. Then later on, we'll look into the criteria to say now, with the 5 criteria we have, how can now they contribute to the success or failure of the forms of ownership. Now, let's start by looking into a sole trader. What do we mean by that? A sole trader is a business that is owned and managed by one person. The characteristics of a sole trader now, this would be your tech shop. These are businesses that are easily managed. Your tech shop can be considered to be one typical example of a sole trader. So characteristics of a sole trader is the idea that there are no legal requirements regarding the name of the business. You can use any name for your sole trader. Furthermore, it is easy to establish as there are no legal formalities in forming the business, and the owner has personal interest in the management and the service that is rendered by the business, and the owner has unlimited liability. Now, this means that the owner is personally liable for the debt of the business, which is what we started by addressing, the issue of unlimited liability. If the business or the tech shop or the car wash is owing, and the car wash cannot itself pay off the debt, then the owner becomes now responsible for what the car wash is owing. Then let's look now into the impact, the positives and negatives of owning a sole trader as a form of ownership. Now, positives: owners or the owner has the freedom to make all decisions, and it is quick and easy. Quick and easy decisions can also be made because sole trader talks to the idea that you are the only owner of that business, so quick decisions can be made. However, a negative is the issue that unlimited liability, which means that the owner is personally liable for all the debts and losses suffered by the business. Then we also look into another positive, which says now it requires little capital to start a sole trader. However, the negative also is the idea that the owner is responsible for providing all the capital needed, which may be difficult to raise a big amount. And then as we look into another positive, all profits belong to the owner, and then that is an advantage. But when we are looking into negatives, growth of the business can be restricted due to lack of capital. So remember, you are the only owner, so it can be difficult to make more money or raise other capital so that you expand your business or grow the business. Then we look into a partnership. What do we mean by that? A partnership has 2 or more partners who own the business. Now, these owners, before they decide on starting the business, they need to have what we call a partnership agreement. So an agreement between 2 or more people who combine labor, capital, or resources towards a common goal, which is to make profit. Characteristics of a partnership: now, partners combine capital and may also borrow capital from financial institutions. Furthermore, profit is shared according to the partnership agreement to say how are they going to share the profit. And then another issue is that partners share the responsibility and they are all involved in the decision-making process. And another issue or another character is the idea that no legal requirements are required when it comes to the name of the partnership. Then no legal formalities are needed as well to start the partnership. Only a written partnership agreement is required. The agreement will be about how profits will be shared. It will be about the responsibilities of the partners and so forth. Then partners has no legal personality, or a partnership has no legal personality, therefore it has no continuity. Then the impact. When we look into the impact, the positives and negatives of owning a partnership, the positives is that the partners are able to put their knowledge and skills together to collectively make the best decisions. And another advantage is that the workload and responsibilities is shared between the partners. And another one is the idea that partners are able to share resources, which we can also take or we can link to the issue of workload, skills, and resources. And then partners are only required to pay tax in their personal and individual capacity, meaning now the partnership as a business will not pay so much tax. And then negatives: a partnership has unlimited liability as a partner's personal belongings can be sold to pay off the debts of the business. And then each partner is legally responsible for joint liability of the partnership. So basically, when one decides to start a partnership, they will be agreeing to say now they are jointly liable for whatever that may happen to that business. And then different personalities and opinions of partners can lead to conflict, which can be caused by the disagreements when it comes to making a decision. And then partners might not all contribute equally. So this is the idea that some partners will bring their skills while some bring capital, which is money. So those who have contributed money might feel that the other partner, because they are only contributing the skill, they are not that important. Then we also have close cooperation. There we start by looking into the characteristics. This is a form of ownership that was discontinued. So when we are looking into a close cooperation, the characteristics explain the idea that it can have a minimum of one or and a maximum of 10 members who share a common goal, and then the name must end with the suffix cc to indicate that this is a close cooperation. And then profits are shared in proportion to the members' interest in the close cooperation. And a close cooperation has its own legal personalities and therefore has unlimited continuity. So what do we mean by unlimited continuity? It says even if one member passes away, the company or the close cooperation can continue to operate. And then each member makes a contribution of some capital, assets, or services towards the corporation. And the word close means that all members are involved and participate in its management. So that's why it was called close corporation. And then members have unlimited liability, except where the close corporation has had more than 10 members for 6 months or longer. Then, when we look into the positives and negatives, there are few legal requirements there as well, e.g., auditing of financial statements or regular annual general meetings. They are not necessarily needed. And then another positive is that a close corporation is a legal entity and has continuity of existence. So when a business or a form of ownership is considered to be a legal entity, it is basically taken as a human being, and we are saying with that they can pay their own tax as well, meaning the business will pay their own tax, and then it can be converted to a private company and members may become shareholders. Then when we look into negatives, limited growth and expansion, since a close corporation can have more than 10 members, and a member of a close corporation can be held personally liable for the losses of the close corporation if the member acts incompetently. And then audited financial statements may be required when applying for a loan of for that business. Then we start with companies. Remember that we have two types of companies. We have profit companies and we have non-profit companies. So what we start with now is what we call profit companies. So we'll be looking into types of profit companies. The first type of profit company is your private company. Now, how do you define a private company? A private company can be formed by an owner who is called a shareholder, and it can be a small or a large company which has one or more directors. Remember, directors are individuals who will be running the company on a day-to-day basis on behalf of the shareholders. Then, characteristics of a private company: it needs a minimum of one shareholder and there is no limit on the number of shareholders. But it needs now a minimum of one shareholder. And then it raises capital by issuing shares to its now shareholders. So remember, when we are saying we have a private company, remember I started by saying these are profit companies. The first one is private, meaning it's privately owned. And then when we are looking into how shares are issued, those shares will be issued privately to individuals or people now with more money to come and invest to that particular company. And shareholders have limited liability. This is to say what the shareholder has invested is only limited to that. If it happens that the company now is bankrupt, they will not have to go and sell their houses and cars to pay off the debt of the company. Then furthermore, the company name ends with the letter PTY Ltd. And then investors put capital in to earn profit from shares. Then the company has a legal personality as well as unlimited continuity. Then a private company is not allowed to sell shares to the public. Then when we look into positives and negatives, we'll start with the positives of having now a private company. Shareholders can vote for or appoint the most capable director to manage their company. Remember, I said it, when you are looking into a company, the issue is that you invest and become a shareholder. However, you do not run the company's operations. The company has to be run by now a director who should be capable and who should have the knowledge on how to run that particular company. Now, that becomes an advantage because it's not like with some other forms of ownership whereby the idea that you have started the business means you should run even if you do not have the capabilities to do so. So another advantage is that a company has continuity of existence. So whether one shareholder passes away or not, the company will still continue. And then when we're looking into own legal entity and also shareholders having no direct legal implication due to the issue of limited liability. And it is also managed by at least one competent or highly skilled director. However, when we look into negatives, it requires a lot of capital for establishment. So for one to start a private company, they need to have a lot of money. So that becomes a disadvantage. And then large management structures can result in decision making taking time. And then the private company is not allowed to sell shares to the public. Is a disadvantage because it means now it limits the amount of capital that can be raised by that particular company. And then directors may sometimes act in their own interest and not in the company's best interest. So that is a negative because remember, directors are appointed or they are hired to run the company, but they do not necessarily have the direct interest as they are just there to manage the company, but they did not invest anything. But with some companies, you get that the people who are appointed as directors, they are also shareholders. So that now becomes a negative aspect about now owning a private company. Then we also have a personal liability company. A personal liability company is very similar to a private company. The difference is that the directors of a personal liability company, let's go back. What is a director? Directors are people who manage the company on a day-to-day basis. So these people make decisions for the company. Remember, shareholders just invest, they put money into the company. However, directors run the company on a day-to-day basis. So when we're looking into a personal liability company, it is very similar to a private company. However, the difference is the idea that the directors of a personal liability company, they are jointly and severally liable for all the debts and liabilities of the company. This means that directors have unlimited liability. So what we mean by that is that, think of it. Let's say you're a shareholder. So as a shareholder, you have invested your money, 200,000 to a company, and the company operates. And then after 5 years, you are told that the company is being liquidated or the company is being bankrupt. The people who are making the decisions on a day-to-day basis are the directors that you shall have appointed or you shall have voted for in an AGM, which is an annual general meeting. So you were basically not involved in the failure of that particular what now company. So what the personal liability company is saying, they are saying now directors, because they are there on the day-to-day basis, they will be liable for the liabilities of the company, because they are the ones who make the decision on what should happen in the company. So that now implicates these directors to be responsible when they take decisions on a day-to-day basis, because they will not take decisions without thinking, because they know that if this company is to be bankrupt, it means they can lose their personal liabilities. So that is the difference between now a private company and a personal liability company. Directors of a private company, they are not liable for any loss that may happen, because they will not sell their assets to pay off the debts of the private company. But directors of a personal liability company will have to pay off the debts of the company using their personal assets. So that is the difference between a private company and a personal liability company. Then, the name as well of the personal liability company ends with I and C, and the name of the private company, remember, it ends with Pty Ltd. However, what are the characteristics? The company name ends with I and C, and then directors have unlimited liability, and they are jointly liable for the debts of the business, even if they are no longer at the office, because they contributed towards the decision that led to the company being bankrupt or to the company being liquidated. And then the memorandum of incorporation should state that it is a personal liability company, and they must at least have one director of their board of directors. And then note that other characteristics of a personal liability company are the same as the characteristics of a private company, except the above mentioned two characteristics. Then, what is the impact there? The positives and negatives again. Note that again, the positives and negatives of a personal liability company, the advantages of a personal liability company are similar to those of the private company. And then the disadvantages are also the same as that of the private company, except that the issue of directors having now personal liability to the company. So you should know that the directors of a personal liability company have unlimited liability. So it means when the company is being bankrupt, because of their decisions that they were taking on a day-to-day basis while shareholders were not there, they will have to also contribute towards paying off the debts of the business. If they do not have the money, remember, unlimited liability means that they will have to sell some of their assets so that they are able to contribute towards paying the debts of the business. So that is that. Then we look into a public company. A difference between private company, public company, very critical. With a public company is a company that is registered to offer its stock, meaning its shares, stock and shares to the general public. This is mostly done through the Johannesburg Security Exchange, which we looked into its function back in term two. So the public company is designed for a large scale operation that requires large capital investments. What are the characteristics now? A minimum of one person is required to start a public company. The company name ends with Ltd. Furthermore, shareholders have limited liability. So it means now if the company is being now bankrupt or being liquidated, the shareholders are only limited to what they have invested. If now they only invested 100,000, they will only lose that 100,000, not their personal what assets, because they have limited liability. So it is limited to what they have invested. Then furthermore, it has legal personality and therefore has unlimited continuity, and then it requires 3 or more directors and 3 or more shareholders. Then profits are shared in a form of dividends in proportion to the share held by that particular shareholder, and then a prospectus is issued to the public to raise capital, and a prospectus will be come through the JSE. Then, what are the positives and negatives? Positives and negatives there. The business has its own legal identity and can own assets and property, meaning a public company, together with the private, they can own assets and buy those assets using the company's name. And then it is easy to raise funds for growth through the sale of shares, and then shareholders have limited liability for the debt of the company, and shareholders may only lose the amount which they have invested. Then, disadvantages: they must disclose all the financial information which can be used by its competitors, and large amount of funds are spent on financial audits for a public company, and directors may not be motivated to work very hard because their shareholders decide on the directors' remuneration. So now that becomes a disadvantage, that directors may not be motivated to work hard because now the shareholders decide on the directors' remuneration, meaning salaries and wages are decided by the shareholders. So that might discourage the directors of a public company. Now, let us look into the difference between public and private company. Now, a private company may not, or they will not be able to offer shares to the general public, whereas the public company trades its shares publicly on the Johannesburg Security Exchange. And then a private company, again, shares are not freely transferable. When we are looking into the public company, shares are freely transferable. There it means you can sell your shares to another individual who's interested in owning or investing in that particular company, if maybe a shareholder is no longer interested. And then when we're looking into a private company, a minimum of one director is needed, but with a public company, a minimum of three directors are needed. And then when we are looking into the name, or how the name must end with now perpetually limited, but when we're looking into the name of a public company, it just ends with Ltd, which is now limited. And then when we're looking into private company, again, the annual financial statements need not to be audited or published. But when we are looking into a public company, the annual financial statements need to be audited and published. Why? This is because now the people who buy shares for a public company, these are individuals that are from the general public. So it makes it necessary for those financial statements to be audited, and for the company as well to publish, so that the general public that would have invested can have access to those financial documents. And then we also have state-owned company. Remember, this is also considered to be a private profit company, because this is also a company that now operates to make profit. But the definition will make it clearer for us. State-owned companies, a state-owned company has the government as its major shareholder and falls under the Department of Public Enterprise. So with a state-owned company, the government is the majority shareholder or has more shares in that particular company. These companies take on the role of commercial enterprise on behalf of the government. These are companies such as the ESCOM. And then characteristics of a state-owned company: the name ends with SOC, and then SOC, or the state-owned company, is listed as a public company, and then it is owned by the government and operated for profit. Hence, I said, even with the state-owned companies, they are considered to be profit companies because they operate for profit. Then it requires three or more directors or one or more shareholders, and then you register with the registrar of companies by drawing up a memorandum of incorporation. And then state-owned companies support private businesses by providing infrastructure, like ESCOM, it is providing infrastructure. And then infrastructure such as communication services, post offices, and supply of electricity, and as in a form of ESCOM. And then the impact now of the state-owned companies, the advantages: their profits might be used to finance other state departments. Maybe the profits made by Eskom can be used now to fund the Department of Education. And then it also offers essential services which may not be offered by the private sector. And then prices are kept reasonable and create sound competition with the private sector to make services affordable to more citizens. However, when we look now into negatives, it may result to poor management as the government is not always efficient as the private sector, and efficiency due to the size of the business as well. Because now when we're looking into companies such as your state-owned companies such as Eskom, those they supply the electricity to the entire South Africa, so it means the size is too big, and to be efficient can be really difficult. It often relies on the government subsidies, which may not cover all the companies' expenses. So those are the positives and negatives of having your state-owned companies. And then now we look into non-profit companies. The definition of a non-profit company: a non-profit company now is not operating to make profit. We should be clear. Now, a non-profit company is not formed with now intent to make profit, but is established to what now? For public benefit. So that is to maybe donate to those who are now not fortunate. Then, characteristics of a non-profit company: the main aim is to provide services and not to make profit, and they are funded by donations and foreign funding. And then the name of the company must end with NPC, and then all profits must be used for the primary objective of non-profit companies, which is to give back to the community or to help now deal with socio-economic issues. It must prepare the memorandum of incorporation, and qualifying non-profit companies are granted tax exempted statuses, meaning they don't have to pay tax. Then advantages and disadvantages: proceeds or surplus funds are used solely for the primary objective of the organization and to further the goals of the business. And then they also provide social services to various communities, and donors, which is donations, receive now tax deduction, and which now motivates them to invest in non-profit companies. And then disadvantages: these now non-profit companies need professional assistance to set up this organization. It does not generate enough capital to cover their expenses, and donations may not always be enough to operate a non-profit company. Then we have cooperatives. A cooperative is a traditional way of a group of interested parties getting together and sharing resources or infrastructures and cost to achieve better outcomes. So this is basically individuals coming together and registering maybe a particular cooperation or cooperative, so that now they achieve better outcomes together. The characteristics: they need to have a minimum of 5 members to start a cooperative, and then the word cooperative limited must appear at the end of its name, and then they are motivated by the service rather than the profit, and they are managed by a minimum of 3 directors, and then decisions are taken democratically. Then members own and run the business together and share equally in its profits. And then legal entity, and it can own land and open bank accounts. Then, what are the positives there? The advantage is access to resources and funding, and decision making is made by a group, and then each member has an equal share in the business, and a cooperative can appoint its own management. And then when you look into disadvantages, decisions are often difficult to reach and time consuming, because remember, there's a lot of members there who participate, and then it is difficult to grow as a cooperative, and it is very few promotion positions or promotional positions to staff. And then it can be difficult to get a loan, because their main objective is not always to make profit. Then we have now a typical exam question. Okay, let us look into our typical exam question again. We have question 1, which is read as follows: explain the difference between limited and unlimited liability for 4 marks. And then we have 2, which says now the instruction is to read the scenario below and answer questions that follow. We have Petra Ltd, Pty Ltd. Now, Petra Pty Ltd needed a large amount of capital for expansion. The management decided to convert the company into another type of company so that they would be able to sell shares to the public on the Johannesburg Security Exchange. Now, 2.1.1, identify the form of ownership Petra Pty Ltd used before they were converted to another type of company, and motivate your answer by quoting from the scenario for 3 marks. And then 2.1.2, explain the characteristics of the form of ownership identified in question 2.1.1 for 6 marks. And then 2.1.3, name the form of ownership Petra Pty Ltd was converted to for 2 marks. Now, let's start with the first part. Limited and unlimited, you should know that because somehow it is part and parcel of the characteristics of all those forms of ownership. But let us look into now the first aspect, which is the difference between the two. Limited liability, this is when shareholders are only liable for the amount they have invested in the company. As I said, with companies, private, public, shareholders would invest. If the company is bankrupt, then it means they cannot now, or there's no law that will force the shareholders to now sell their personal assets so that they pay off the debts of the business. Hence, we have the example. An example is that if the business is bankrupt, the personal positions of the shareholders, which makes the owners, cannot be used to pay off the debts of the public or of the business. So this mostly applies to companies. And then unlimited liability, this is when the owners are personally responsible for now the debts of the business. So for a sole trader and for a partnership, this is largely applied. An example is that if the business is declared bankrupt, the personal positions of the sole trader or a partnership or partners might be sold to pay off the debts of the business. So that is how you would obtain your 2 marks there, and then max, and then you get 4 out of 4 for that particular question. Then, as we proceed now, we look into the issue of the scenario. The answer there was supposed to be private company. Why are we talking about private company? Because you are supposed to look into the issue of the name as well. Pty Ltd, and the question was clear. Identify the form of ownership Petra Pty Ltd used before they were converted. Remember the scenario I was telling you that now their management decided to convert the company into another type of company so that they would be able to sell their shares to now the public on JSE. So it means now they wanted to move from being a private company to now a public company. So the question, you need to read your questions and understand. The question said now, identify the form of ownership that Petra Pty Ltd used before they were converted. So before they were converted, they were a private company. 2 marks. Motivation is because Petra Pty Ltd needed a large amount of capital for expansion. So that is your motivation over there. Then we move to now saying the characteristics of the form of ownership identified in 2.1.1. It needs now, what does it need? It needs a minimum of 1 shareholder, and there's no limit on the number of shareholders as well. And then it can raise capital by issuing shares to its shareholders, and shareholders have limited liability, and the company name ends with Pty Ltd, and the investors put capital in to earn profits from shares in a form of dividends, and then the company has legal personality as well as unlimited continuity. And we also look into the issue of saying a private company is not allowed to sell shares to the public. So that is, or that makes your characteristics over there. And then that's how you get your 6 for those, and this is maximum. And then the name of the name, the form of ownership now, Petra Pty Ltd was converted to a public company. That is correct. 2 marks for that. Now, the second part of our lesson now is to look into criterias to say how can the criterias that we are about to talk about contribute to the success or failure of a form of ownership. This is to say, if one day you want to start a business, and I believe you should start a business, because remember, with business studies it becomes a very important subject, because whether you will be a doctor, whether you will be a lawyer, whether you will be a nurse, an accountant, or what, at some point you'd want to run a business. So these skills would basically help you to understand how to formalize your business and how to own your business. So before deciding on the form of ownership that you would want to use for a business, you need to look into these criteria. A criteria like the tax implication, together with management, together with capital needed to start that particular business, and the division of profits, to say how would you divide the profit, and the issue of legislation or legal requirements. So basically we are going to look into all those to say how can now they contribute to the success or failure of each form of ownership that we are going to address. So the criteria, what do we mean by tax implication, the tax requirements for each form of ownership will determine the impact of taxation, and it will also determine the business success or failure, to say is that particular form of ownership going to be affected by so much tax or not. So we'll be looking into the success and failure for different types of forms of ownership. Then we'll also look into management to say ownership as well, impact on the management function, which determines the success or failure of the business. We also look into management to say, now, is it easy to make decisions under some forms of ownership or is not? With a sole trader, we know that sole trader is run by one person who makes all the decisions. But with a partnership, we know that you have partners which now have to be involved in the process of making a decision. So we'll be looking into how successful or how that contributes to the failure of the business. And then we look into capital. Capital has to do with the money now needed to start that particular form of business or form of ownership. So it refers to the ability to obtain capital. So some forms of ownership would allow the owners to get capital very fast. So hence we say it refers to the ability to obtain capital from various sources, e.g. owned or borrowed capital. The amount of capital that can be sourced will also impact on the business success or failure. We know that a sole trader is a very small business which can have difficulties when it comes to getting capital, but when you're looking into companies now can get more money when it comes to running their operations. And then we also have division of profits, which refers now to how profit is divided between owners, shareholders, or investors of that particular business. And we also have legislation, which has to do now with the law. Legislation or legal requirements for establishing or starting a business, impact on the establishment cost. Establishment cost has to do with how much you need to start that particular business, how much does it cost to register that particular business, how much capital is actually needed to start that particular business, and the time before the business can legally do its operation or do its business. Then let us look into now the criteria that contribute to the success or failure. The first one we'll be looking into, remember, is the issue of management. So we'll look into a sole trader as a form of ownership and look into the success and or failure factors when it comes to management. Now, we know that a sole trader is owned by only one individual. So one owner, so the success part becomes the idea that the one owner, there is no disagreements there, and they can make quick decisions without having to consult with others. But when we look into failure now of your sole trader, owner The owner has to do all the administration, management, and decision making in the business alone. And sometimes it doesn't necessarily mean the owner will always be right. So they need somewhere, somehow to consult with others and get some other people's input. But that can now become a failure of a sole trader because the owner will make all the decisions alone. And again, they will have to make the administration and run the entire management alone. And then another failure when it comes to now a sole trader with management issues is that owners have to rely on their own decisions and could make incorrect ones. So that also affects the management part. Then taxation. Owners they're only taxed on profits in their personal capacity. So it becomes the advantage there to say the business is not being taxed, but the owner of the business is the one that has to pay tax in now their personal capacity. And depending on how much income the owner earns, his or her now tax rate may be lower than that of a company tax rate. And then the failure part when it comes to taxation of a sole trader is that if profits get too big, they may end up paying high tax in their personal capacity. And another failure is that failure by the owner to comply with the personal income tax regulations could lead to substantial financial penalties imposed by SARS. So that is the failure when it comes to now owning a sole trader and taxation. So the implications is that the success is that you're being taxed on your own personal capacity. But then the failure is the idea that if you do not pay or do not comply with the SARS regulations, you can pay high penalties. Then we also look into the capital needed for a sole trade. Capital can be carefully spent and managed. That is one advantage or success, and the owner might be now able to borrow money from the financial institutions, especially if he or she has assets that can be used as surety for that particular loan. However, failure is that profits may not be large enough for expansion. And then another one is that now they cannot appoint people with large salaries and the owners are responsible for any capital borrowed. Then division of profits when it comes to now sole trader as well. Remember, we analyze or we look into these 5 factors to say how can they affect the success and the failure of that particular form of ownership. How profit is to be divided with a sole trader. The success part is that the owners will receive all the profits from the business, which can lead to capital growth. And also another aspect is that the owner may use the profit to expand the business. The failure, however, becomes the idea that the owner needs to budget carefully so that the business debts are all covered. And if the owner does not make profit, the income and the livelihood of the owner might be severely affected. Then, when we look into legislation to say how easy it is to start a sole trader, the success aspect is that it is easy and inexpensive to start a sole trader, meaning little amount is needed. And when it comes to registrations and so forth, it becomes easier as well to start a sole trader. However, the issue can be now unlimited liability, which is now legislation, the law. The law says now sole traders have unlimited liability. This is to say, it may encourage the owner to work harder to ensure that the success of the business is achieved. So that is with the success there. The issue of unlimited liability means that now, if the business is to owe anything, the owner knows that they might have to sell their cars, they might have to sell their house. So it means now they are going to work hard to ensure they do not get to that situation. However, the failure of the legislation when it comes to a sole trader is that they have unlimited liability, and then personal debts and business debts are not separated. So it means the debts of the business and the owner's personal debts are basically brought together. So whatever that is going to happen, it can affect the owner. So they mostly comply with relevant municipal regulations, and it could also it could be enforced to an extent that the sole trader is forced to close. Then we move to another form of ownership, and we look into those 5 criteria and look into the success and failure. But now we are looking into a partnership, management of a partnership. What are the success factors there, and what are the failure factors? The success factors of now managing a partnership is that partners are actively involved in management, and they may use ideas of other partners to make more money for the partnership as a business. And then partners have access to expertise of other partners, which now when difficult decisions have to be made, it can make it easy for them. And then failure, when we are looking into management, decision making can be time consuming as all partners have to be in agreement. And then another aspect of failure when it comes to management is that partners may disagree on how to run the business, which may lead to the tension between them. So that can become now a failure aspect when it comes to management, because partners want to give out their input and some may not agree on how things should be done in the partnership as a business. Then we look into other criteria. Taxation now. How will this partnership business pay tax? What are the success factors, and what are the failure factors for that particular partnership? Now, partnership pay VAT, value added tax, only on relevant products sold or services rendered, which reduces tax administration. And then another success factor is that the partnership does not pay income tax, and only partners in their personal capacity. So the partners do not pay tax, they only pay tax on their personal capacity, meaning each and every partner will pay in their personal capacity, but the partnership as a business will not pay tax. However, what are the failure factors when it comes to the tax implication? High earning partners pay more tax, which may discourage other partners from joining the partnership. Remember, the partnership may want to grow, and they may want to add some other partners. So the idea that those who are high earning from the business as a partnership, they will be paying high tax, it might discourage others from joining the partnership. And then partners may withdraw more cash to reduce their tax burden, which may cause cash flow problems from the what partnership. Now, meaning when we're talking about the issue of partners withdrawing, we are saying partners might take the capital they have contributed so that they reduce the tax they have to pay in their personal capacity. Because remember, in a partnership, the agreement most of the time is to say when a partner has contributed more capital, when it comes to the process of sharing profits, they would have to share a higher rate of profit. So that higher rate now will also implicate on the tax that is to be paid by that particular partner. Then we look into another factor, which is capital. Now, when it comes to partnership, capital can be carefully spent and managed, and more than one partner contributing capital is also a success factor, because remember, it means more people will be contributing and the partnership can have more capital to operate that particular company. However, the failure part when it comes to a partnership as a business, partners may not all they may not all have capital to put into the business when it's needed, and unequal inputs, as some partners put in expertise instead of the cash. So that can also lead to a failure, because some partners may feel like, because why are we contributing money while others are only contributing their skills towards the business? So that may lead to a failure, because some of them may want to dominate the decisions that are being made with the idea or with the perspective that they have contributed money in that partnership. Then We look into division of profit. We are partners. How will we divide the profit that is made by our partnership business? Partners share profits according to their contribution. If you have contributed 100,000 towards the partnership, obviously you will share more than an individual who has contributed 50,000 towards the partnership. That is the success. But the failure now is that the amount of work done may not be equal to the amount of profit that each partner receives now. Some partners may only contribute more money, but they may not have the expertise to generate or make money for that particular partnership. And then legislation, when it comes to starting your partnership, it is easy and cheap to establish. And as partners, must just draw up a partnership agreement on how they're going to share the profit, on how they're going to take decisions. And then partners are more motivated to make success because their personal positions are at risk. So this is to say we should know that the legislation of a partnership as a business is unlimited. So if it happens that the partnership as a business is failing or is bankrupt, the partners know that they might have to sell their personal assets. And then when you're looking into failure, unlimited liability, or partners are jointly and severally liable for the debts of the business. So the issue of unlimited liability becomes a failure when it comes to one thinking about having a partnership as a business. And if one partner dies or retires, the remaining partners need to draw up a new partnership agreement so that they have new terms because the other partner is no more or has retired from the business. Then we look into now a private company. What are the success and failures of a private company? Management, we know, I explained it. A private company is a profit company. They operate to make profit. And how is the structure of a company? A company has shareholders, but shareholders do not run the company. The company is to be run by the directors. So management, what are the success there? It is managed at least by one competent or highly skilled director. That is a company. It is run by a highly skilled director who will make the right decisions for the company. And shareholders can vote for or appoint the most capable director to manage their company. However, when you are looking into failure aspects of the private company now, directors may not have direct interest. Remember, look into the success point there. Shareholders can vote and appoint directors who are capable. So these directors did not invest towards the company. They do not have any money that they have contributed towards the company. So hence the failure of allowing these directors now to run the company on a day-to-day basis is that they do not have direct interest. It's because they did not contribute any income or any money towards the company. So they do not have direct what? Interest in making sure that the company becomes successful, which can hamper the growth and profit maximization because the energy will not be there to make more money and come up with ideas that generate them more money because the directors know that we are basically coming up with these ideas, but the people who will benefit are the shareholders. So that can lead to a failure now of managing a private company. So directors' fee may increase the company's expenses, which may reduce the net profit. And the net profit now has to do again with the dividends that can be issued to the shareholders. So that is the failure, or those are the failures when it comes to private company and its management. Taxation. We are looking into now the success of a private company when it comes to its tax implication, how they have to pay the tax. Now, the business or the company can obtain tax rebates if they are involved in CSI projects. Remember, we did CSI project and we did CSI, corporate social investment. It has to do with the money that is invested towards the community so that they improve the standards of living in the community. So as the private company invests towards the community, their success there is that they will obtain tax rebates, or their tax can be reduced because they are giving back to the community. Remember, immediately we think about tax, the tax is revenue to the government, and the government will provide public goods and services. So if the company is already engaged in a corporate social investment, it means the company is also contributing towards providing some public goods and services. So it means they will receive tax reduction or tax rebates because of that particular CSI, corporate social investment. So it becomes a success now of running that private company. And it can also obtain government tenders and renew their license if they do not evade tax. That is a success as well. But failure now is that they are subjected to double taxation, e.g., shareholders may pay secondary tax. This can have a negative impact to a company that is already financially struggling. That is the implication when it comes to a private company. And then capital of a private company, what are the success when it comes to capital that can now be contributed to a private company? Large amounts of capital can be raised since there's no limit on the number of shareholders for a private company, and the company can access long-term capital. Therefore, it has good long-term growth opportunities. What are the failures, though, when it comes to obtaining capital? It cannot grow into a very large business since it cannot invite the public to buy shares. So this is to say, now the idea that this is a private company and it cannot now attract the general public to come and buy shares. It means it has limited capacity to grow their capital, and then large amounts of capital cannot be obtained as capital contribution is only limited to the private shareholders they have. So that is a failure when it comes to contributing capital. It's a private company, remember, so it means it has private owners. And then division of profit. How is the profit going to be divided when it comes to now a private company? Remember, shareholders receive their profit in a form of dividends. So high profits and good returns to shareholders indicate the success of a company, which increases the value of their shares. So as the profit, or as the dividends, or as the company makes more profit, the value of their shares would improve. If the shareholders bought their share at 20 rand, and if the company now continues to make more profit, the share price, or the share of the price of each share can improve to 50 or to 70 rand, depending on the company performance. So another issue is that shareholders receive profits according to the type or the number of their shares. Remember the types of shares. There are two critical shares. We have ordinary, and we also have preference. Remember, preference, they receive fixed, but ordinary shareholders receive profit depending on the profit that was made, the net profit that was made. Hence, here they say when it comes to division of profit, they receive profits according to their type of shares and the number of shares they have. Then, when you're looking into failure, shareholders may sell their shares when dividends are low, resulting in a drop in the share price. That is to say, now when the company is underperforming, the value now of the shares, if the share price was 20 rand and the company is underperforming, it might now decrease the value of the shares maybe to 15 rand, and if it further now underperforms, the share price can be reduced to 10 rand. So that is the failure when it comes to profits of a private company. And dividends are not always paid out, which may discourage new investors. But remember, dividends are only issued when the company has made enough profit. Then, legislation of a private company, success and failure. This has to do with how to establish or how to start a company. Companies which comply with the legislation build a positive image and may attract now investors. So companies have to comply with legislation. We talked about legislation. Term 1, you have your Skills Development, Employment Equity Act, Basic Conditions of Employment Act. If a company complies with those legislations, they build a positive what? Image, and may attract investors. Then they also have a legislation which has to do with continuity of the existence due to the legal personality of a company, and shareholders have an advantage because there's limited liability, which allows for greater risk taking, which may lead to growth of the business. And then when you look into the failure, the formation procedures are now time consuming or complicated or very expensive, as many legal documents need to be prepared and submitted. And then another failure is that your annual audits of the financial statements that are required can be very costly for the company to actually conduct, because they have to hire accountants, and it is a legal matter that has to be done within a private company. Now we look into a public company. When it comes to management, the success and failure of the public company, it can be more or the same of that one of a private company. It is managed at least by one competent or highly skilled director. That is management of a public company. Shareholders can vote for or appoint the most capable director with the right skills to manage their company. That is for a public company. Remember, the difference is that a private company has shareholders who are maybe invited privately to come and invest, but with a public company, the general public would be attracted using a prospectus to say they can come and invest, and if they're interested, they buy shares of that particular public company. What are the failure aspects there? Directors may not have a direct now interest in the company, which can hamper the growth and the profit maximization of that particular public company. Remember, with a public company, again, directors are also now people who did not contribute towards that particular company in most cases. So now they do not have the energy, they do not have the drive to make the company or to ensure that the company is successful. So large management structures can result in decision making taking time, because with general, it means now they have to involve a lot of people in the process of making the decision. Then other factors to consider: tax. How will tax be paid? A public company as well. Remember, the idea that is a public company, it has nothing to do with your government. Public is just the idea that the company can sell their shares to the general public. And then when we are looking into taxation, it can obtain tax rebates if they are involved in CSI projects. What is a CSI project? Corporate social investment. So if the company is giving back to the community, they are creating programs, they are offering bursaries, they can reduce their tax, which becomes an advantage or a success. And then they can obtain government tenders and renew their licenses if they do not evade tax. And then failure, they are subjected to double taxation. Shareholders pay secondary tax. This can have a negative impact on the company that is already financially struggling. So you see these points, they are very similar to that of a private company. They are very similar to a price. So basically, when you have studied this aspect of taxation, you have studied the same responses for a private company. Then capital, they can raise a large amount of capital as shares or debentures can be sold to the public or now shareholders. Now, this becomes different compared to that one of a private company. And because the idea here is that a public company can sell shares to the public, so it becomes an advantage. And they can also sell debentures, which is now an instrument we talked about when we're looking into investment securities. And then a public company's shares are public companies' shares are listed on the Johannesburg Security Exchange, which gives the company exposure to more potential investors. Then failure when it comes to capital that can be contributed. Large amounts of capital are required for one to start a public company, and raising extra capital might be difficult if the economic climate is unfavorable or the share price changes all the time, and they may lose value in the long run. Then division of profit of this public company. Now, what is the success there? How will the shareholders divide their profit. The high profits and good returns to shareholders indicate the success of the company, which will increase the value, and shareholders receive profits according to their type and number of shares. Remember, this is similar to the response we got from the private company. And the failures, the idea that shareholders may sell their shares when dividends are low, resulting in a drop in the share price, and dividends are not always paid out, which may discourage new investors. This is also similar to what we went through when we were looking into a private company. Then legislation, what is the law saying when it comes to establishing or starting now a public company? The idea that the company and its owners are shares are separate entities, which may encourage more people to join the company. So this is to say, when we are saying the company and its owners are separate entities, it means now what the company is owing is limited to the company, and what the owner is owing is limited to their personal capacity. And then limited liability allows greater risk taking, which may lead to growth of the business. However, failure is that the formation procedures are time consuming, complicated, and expensive, as many legal now documents are needed to be prepared and submitted for the company to actually start operating. And high formation and establishment expenses require a large amount of startup capital. Then we also look into personal liability company management. Remember, personal liability company is similar to a private company. So when we are looking into a personal liability company, it is managed by a competent board of directors who might be experts in their field, and quick decisions can be made even if there's only one director. However, the failure when it comes to management, it implicates the directors. Remember, when we were talking about personal liability company, we said the directors have unlimited liability. So directors may not have direct interest in the company, which can hamper the growth and profit maximization. And the director's fee now increase the company's expenses, which reduce the net worth profit. Then taxation, they can obtain tax rebates if they are involved in corporate social investment. So this is similar to basically what we went through for the public and the private company. When you're looking into the government tenders as well, this is also similar, the licensing as well. And then PAC, the public personal liability company pays tax after business expenses have been now deducted. Then the failure is similar to that of a private company. Why? Because we are saying they are subjected to double taxation. If you look into your notes, you'll see what I'm talking about. And then shareholders pay secondary tax. This can have a negative impact when it comes to running this personal liability company. And then when we're looking into capital as well, capital can be increased by getting more shareholders, and the failure now is that it cannot grow into a very large business since it cannot invite the public to come and buy shares, and restrictions on transferability of shares may not attract financially strong investors. Then division of profit, high profits and good return to shareholders indicate success of the company, which increases the value of the shares, and profit generated can be reinvested to expand the business operation. Then shareholders may sell their shares when dividends are low, resulting in drop in share prices, and then dividends are not always paid out, which may discourage new investors. So as I'm saying, some aspects are similar, especially when you are looking into private, public, and your personal liability company. Legislation of the personal liability company. Yeah, the issue here is that the success is the idea that the company and its owners are separate legal entities, which may encourage more people to join the company. And the legislation now implicates directors, since this is a personal liability company, to say directors are forced by the act to act responsibly and work harder towards the success of the company so that they protect their personal assets. Because if the company is to be liquidated, the directors will also contribute towards the liquidation or the bankruptcy. And then lengthy registration required to register this company, which will delay the actual operations of the business, and shareholders can lose profitable opportunities. It is expensive again to register this form of ownership, which increases the business expenses, hence reducing the profit. Then we look into now the success and failure of a non-profit company which is operating not to make profit. Now, a non-profit company may be well managed as it requires a minimum of 3 directors, and more directors may be appointed to bring more ideas or skills, innovations, and aspects to the non-profit company. And then the failure is that now large management structures complicate or delay decisions. It takes time because there's a lot of people to consult. And then directors may mismanage the business funds as they may not have direct interest in the non-profit company. And then taxation, they may qualify for tax exemption if certain criteria are met, and they may receive certain tax benefits or rebates when they are actively involved in the community project. However, taxation, again, the failure is that it is required to pay income tax if engaged in what now activities that are unrelated to their business purpose. Remember, their business purpose is to make non-profit. So they must meet certain tax requirements to be exempted, e.g., operations must be exclusive for charitable, scientific, public safety, and purpose. Then, capital. The idea that now what makes success of a non-profit company is that unlimited number of founders may contribute more capital to the company. However, failures that founders may contribute limited capital. This is because they know that the focus is not only to make profit. So they might contribute limited capital or may not contribute capital, which may not be sufficient for the establishment or operations of the company. And then division of profit. The profits of the company are used to finance other needs of the company, and they may discourage potential now investors from investing in the company, as this is a non-profit company. So the profits are used to now fund the needs of the company further. Then, legislation, the company and its shareholders are separate legal entities which may encourage more people to join, and the financial statements are audited. This may result in effective use of resources. And then when you look into failure, formation procedures are time consuming, complicated, expensive, as many legal documents might be prepared or submitted. Now, we have our last typical exam question. What we just looked at is the very, very critical part of your forms of ownership, because when we're looking into characteristics, they were dealt with, especially in grade 10 and grade 11. But the focus of grade 12 now becomes the criterias. You need to know the 5 criterias and know how they contribute to the success and failure of the different forms of ownership that must be chosen. So let us look into these typical exam questions and we will deal with it and complete our lesson. Let us look into our typical exam questions. Now, we were instructed to read the scenario below and answer questions that follow. We have Zama and Quintin, who are qualified lawyers who have started a business. Now, they called their business Z&Q Attorneys, which lacks continuity. They want to convert their business into a personal limited company. Now, name the form of ownership that Zama and Quintin are currently operating, and motivate your answer by quoting from the scenario for 3 marks. Now, remember, it lacks what? Continuity. That should be your key word there to identify which form of ownership is Zama and Quintin using there. Any business that lacks continuity and has 2 people operating it, can it be a sole trader? No. Can it be a company? No. Because remember, a company doesn't lack continuity. It has unlimited continuity. So now this makes this company what? A partnership or what? But let's see. We will see with the solution. Now, the answer is supposed to be partnership, yes, because a partnership is a business that is owned by 2 or more individuals. And then how do we see that? The issue of lacking continuity becomes very key as quotation for your motivation. Now, that is how you get your 3 marks. And then we are looking into how now a partnership can contribute or we are looking into explaining how division of profits and taxation can contribute to the success of a personal liability company. One, high profits and good returns of shareholders indicate the success of a company, which will increase the value of what now? Shares. That is one. Two, and then profits are now generated, or profit generated can be reinvested to expand the business. That's correct. And then shareholders may sell their shares when dividends are low, resulting in drop in the share price, and dividends are not always paid out, which may discourage investors. That we get four from that. And then we look into now taxation. When you're looking into taxation there, the taxation, they can now obtain tax rebates if they are involved in corporate social investment projects. That one is correct. And then we also look into the idea of now they can obtain government tenders and renew their license if they do not evade tax. And then PLC, again, personal liability company, only pay tax after they have paid their what now expenses. However, negatives are that shareholders may be subjected to double tax, e.g., shareholders pay secondary tax. This can have a negative impact to the company that is already financially struggling. Then, summary of our lesson, we looked into your limited and unlimited liability, and we also looked into the following forms of ownership: your sole trader, partnership together with close cooperation, and private company together with personal liability company, and public company with state-owned company together with non-profit companies and cooperatives. Now, this was the lesson. We looked into defining each form of ownership. We also looked into the characteristics and the advantages and negatives of each form of ownership here. And we also looked into how these forms of ownership can contribute towards now the success and failure, considering the 5 criterias, which is your management, your capital, tax implication, division of profits, and legislation. So that was our lesson. Just remember that your education is very, very key, and you should take care of yourself. As I always say, tough times never last, but tough people do last. Thank you.